Ever looked at a company's financial report and just wondered, what kind of incredible precision and planning goes into making those numbers truly trustworthy? It's like seeing this huge, impressive building and trying to picture the original blueprint.
Exactly. It really is a meticulously crafted journey. It demands not just sharp financial acumen, but also really immersing yourself in the client's world and often bringing in the specialized skills of, well, a whole team of different
And
experts.
that's exactly why we're here today. Our mission for this deep dive is to pull back that curtain a bit. We're going to unpack the whole foundational process of audit planning, and then we'll explore how auditors leverage all sorts of diverse expertise to, get the job done right.
Yeah, the goal is that by the end, you'll have a really clear, solid understanding of what makes those financial statements reliable.
Without feeling like you just waded through a textbook, right? So let's dive into this vital process. Okay, let's start at the beginning then. What exactly is audit planning? And maybe more importantly, why is it so absolutely crucial?
Well, at its core, audit planning is essentially creating the complete roadmap for the entire audit. It's that vital first step. It's where the auditor really digs in to understand the client's business, their industry, develops an overall strategy, creates a detailed plan, and performs those initial risk assessment procedures.
Okay.
And all this meticulous preparation. That's what ensures the audit is actually effective in identifying and assessing any potential risks of, well, material misstatement in those financials.
So it's not just a suggestion, it's fundamental.
Absolutely. And the intensity and the scope of this planning, it isn't the same for every subtle audit. It really depends on a few key things.
Like what?
Think about the size and complexity of the company itself. A huge global conglomerate, that's going to need a very different planning approach than, say, a local small business.
Makes sense.
Our prior experience with that specific client also matters quite a bit. And of course, any big changes happening within their business or maybe in the broader economy,
Yeah.
a less complex operation might just have fewer business lines or maybe a more centralized accounting setup, that kind of thing.
Right, so you're tailoring the approach each time. It's about setting the stage correctly for that specific situation, not just using a generic script.
That makes a lot of sense.
Exactly. The passkey concept here is that the audit plan responds to that initial risk assessment, but it absolutely has to be revisable. It's a living document, really, because things can change based on what we find during the audit procedures.
Okay, so it's adaptable. Now, who are the key players actually drawing up this blueprint? It sounds like a team effort, not just one person locked in a room.
You're spot on. It's definitely a team effort. While the engagement partner, they have the ultimate responsibility for the whole audit, planning it, supervising the team, making sure everything complies with auditing standards.
The buck stops with them, essentially, pretty much. But other key members of the audit team are all involved in the planning process. It's collaborative. And a really critical piece, mandated by GA's generally accepted auditing standards, is the proper supervision of assistants. This isn't just about checking boxes. It ensures the work being done is actually sufficient to hit the audit objectives and, ultimately supports the conclusions in our final report.
So what does proper supervision actually entail?
It means the engagement partner is actively directing the team's efforts. They're communicating potential risks, like fraud risks, making sure assistants fully grasp their responsibilities, and staying informed on any significant accounting or auditing issues that pop up.
Okay.
They also need to thoroughly review the work papers, check for adequacy, proper documentation, and the level of supervision, the nature, extent, timing that can vary. It depends on the complexity of the entity, the specific tasks assigned, the risks we've assessed, and frankly, the qualifications of the assistants themselves.
And what if people disagree? Does that happen?
It can, occasionally. If disagreements arise among two members about an accounting or auditing matter, there's a process. Usually it involves bringing in the partner for resolution, and that final decision, whatever it is, has to be documented.
Okay, makes sense. Now, shifting gears a bit, before you even start crunching numbers, don't auditors need to become almost like mini experts in the client-specific world? I mean, you couldn't audit a cutting-edge tech startup the same way you'd audit, say, a 100-year-old manufacturing plant, right?
That's a fantastic point, and you're right. While we aren't actually required to have prior experience with a client's specific business or industry before we accept an engagement.
Oh, interesting.
Yeah, but once we're on board, obtaining a thorough understanding is absolutely mandatory. It's like learning the unique language of their business.
So how do you get that understanding?
Well, first, there's gaining knowledge of the client's industry. This is important because different industries have unique practices, maybe specific accounting treatments or particular regulations that can really impact their financial statements.
Where do you find that info?
Oh, various places. We might use specialized industry guides from the AICPA, read trade publications, look at government reports, even AICPA's accounting trends and techniques. It helps us grasp the typical risks and operational moms for that sector.
Okay, so the industry context first. Then what?
Then we dive into knowledge of the client's specific business. This gives us that crucial context for understanding why certain events and transactions happen and how they might affect the financials. We gather this in a few ways.
Like how?
Often we'll tour client facilities. This is incredibly valuable, especially for new clients. Imagine walking through a factory. You see the assembly lines, you meet the production managers, you observe their inventory processes firsthand. It gives you a perspective you just can't get from staring at a spreadsheet.
I can see that. Getting a feel for the place.
Exactly. We also review the client's financial history, looking at past audit reports, annual files, permanent files, prior financial statements. This can reveal trends, maybe recurring issues. We look at meeting minutes, communications with third parties, SEC filings if they're public, Dun& Bradstreet reports, even tax returns.
Wow, thorough.
And we need to understand the client's accounting methodology. How do they actually gather and process financial information? What technology are they using? Do they rely on outside service organizations? We review their policies and procedures manuals. This helps us see how their systems are built, which definitely impacts our audit approach.
Okay.
And finally, pretty straightforward, we inquire of client personnel. We talk to people about current business developments, challenges they're facing, anything new going on.
So once you've got that deep understanding, that whole landscape mapped out, how do you actually chart the course for the audit itself? This feels like where the real strategy comes in.
Exactly. This is where the overall audit strategy takes shape. Think of it as the high-level game plan. It outlines the scope of the audit, the reporting objectives we need to meet, the timing when key things need to happen, and any required communications.
And it flags the important stuff.
Crucially, yes. It identifies the factors that will determine the primary focus areas of the audit. And developing this strategy early, it's key because it directly tells us what resources we'll need.
Recourses like
Deciding if we need to bring in other auditors, maybe specialists for certain areas, how much we can rely on the client's internal auditors, assigning our own staff effectively, figuring out the best timing for specific tests, even budgeting the hours for different sections of the audit.
Got it. So what kinds of things determine that audit focus?
It's shaped by our initial thoughts on materiality. What size of error would actually matter, and audit risk. We also look at which locations or account balances are most material, areas that just inherently carry a higher risk of misstatement, any significant accounting changes the client has made recently, and big developments in their business or industry. Management's commitment to controls is also a factor.
And the scope, what defines that?
Several things define the scope. The basis of reporting like GAAP or IFRS, the currency used, the different locations we need to cover, specific industry or regulatory requirements, the entity's size and complexity again, the impact of IT, our own prior experience if they use service organizations, recent changes, even how much evidence we expect to get from their internal controls.
Okay. And you mentioned reporting objectives and timing.
Right. The strategy also considers reporting deadlines, key meeting dates with management or the board, the types of reports we expect to issue, and how communication will flow within the audit team and with any third parties.
Seems like a lot for smaller companies, too.
Well, for smaller or less complex entities, the strategy might just be a brief memorandum, but the thinking process behind it, just as vital.
Okay, so the grand strategy is set. Now, let's get down to the nitty-gritty. How does that strategy turn into a concrete, actionable plan with, specific steps to follow?
Right. So building on that strategy, we developed the audit plan. This is a much more detailed document. It lays out the precise nature, extent, and timing of the specific audit procedures we need to perform. And these procedures are always tailored to the relevant assertion level for particular accounts, transactions, or disclosures.
Assertion level.
Yeah.
We'll definitely need to unpack that term later.
We will. And a key point here, the passkey, is that a written audit plan is always required. It's the formal documentation of all these specific procedures.
Got it. Written plan required. What kinds of procedures go into it?
We generally categorize audit procedures into risk assessment procedures and further audit procedures.
Risk assessment.
That's our initial detective work. We use them to understand the entity, its internal controls, its financial reporting framework.
To sniff out the potential problems.
Exactly. This helps us assess where the risks of material misstatement might be lurking. And that assessment then guides the nature, extent, and timing of our further audit procedures. But, and this is important, these initial risk assessment procedures, on their own, are not enough evidence to form our final audit opinion.
Okay, so they guide the work, but they aren't the whole story. What are the further audit procedures then?
Right. Under further procedures, we have two main types. First, tests of controls. This is where we evaluate how effectively the company's internal safeguards are actually working to prevent or detect misstatements.
Like checking if approvals are really happening.
Precisely. Checking if two people really do sign off on every big expense, for example. These tests are crucial when our risk assessment actually relies on those controls being effective, or sometimes when substantive procedures alone just won't cut it.
Okay. And the second type?
The second type is substantive procedures. These are designed to directly detect material misstatements in the financial statements themselves. This includes detailed testing of transactions, account balances, and disclosures. It also includes using substantive analytical procedures, basically, looking for unusual trends or fluctuations in the numbers that don't make sense.
And you always do these?
Yes. Substantive procedures are always required for all relevant assertions related to material account balances, transaction classes, and disclosures, regardless of how good we think the controls are. We also have things we might call other audit procedures, like sending a confirmation letter to the client's attorney.
You also mentioned specialized areas, like ERISA plans.
Right, good point. For certain audits, like ERISA retirement plans, there are very specific procedures required by regulations. We might need to review the plan documents, check the plan's tax status, evaluate potentially prohibited transactions, and see how those are reported. Sometimes this might even lead to modifying our audit opinion. There's even a specific type of ERISA audit where we might rely on certifications from financial institutions for investment information. But we still have procedures to follow even then. It just highlights how the basic plan needs to adapt.
Okay. And what about the timing of all these procedures? Does it all happen at year end?
Not necessarily. The timing of audit procedures is also a critical planning element. We might perform interim testing on certain accounts well before the company's year end.
Why do that?
It helps spread the work out, get a head start.
Sure.
But if we do interim testing, we then have to assess any additional risk between the interim date and year end and figure out what additional work is needed to extend our conclusions to the actual year-end balance sheet date.
And technology must play a role here too.
Oh, absolutely. Information technology has a huge effect on timing. In highly computerized systems, some data might only exist electronically for a very short time before it's overwritten or archived. So we might have to schedule our procedures very specifically to capture that data while it's available. Sometimes we might even need to perform tests multiple times throughout the year because of how the IT systems operate.
Okay, this is really detailed. You mentioned assertion level a few times now. Let's circle back to that. What exactly are these financial statement assertions, and why are they so fundamental to an auditor's work?
That's a really fundamental question. The key idea is this. Financial statements aren't just, statements of objective fact. At their heart, they are claims and assertions that management is making.
Claims about what?
Claims about the recognition, measurement, presentation, and disclosure of all the information within those statements. The auditor's job, essentially, is to gather evidence to test whether those claims, those assertions are actually true and fair.
Okay, so what are the main assertions?
There are 6 main financial statement assertions, and there's a helpful mnemonic people often use to remember them. Cover up.
Cover up. Okay, I'm intrigued. Let's break it down.
Sure. C is for completeness. This means everything that should have been recorded, transactions, account balances, disclosures, has been recorded and included. Nothing significant got left out.
Makes sense. No omissions.
Right. O is for cutoff. This is about timing, making sure transactions are recorded in the correct accounting period. Did that sale that happened in January accidentally get recorded back in December?
Ah, got it. Period accuracy.
Exactly. V is for valuation, allocation, and accuracy. This ensures that account balances, transactions, disclosures, they're all recorded fairly, measured at the appropriate amounts, and any necessary valuation adjustments, like for inventory or receivables, are applied correctly. Are things valued right?
Okay, the numbers themselves are right.
Yes. E is for existence and occurrence. This confirms 2 things. That assets and liabilities actually exist, like cash in the bank or physical inventory on the shelves, and that recorded transactions, like a reported sale, really did happen and pertain to the entity.
So it's real, and it happened.
Correct. R is for rights and obligations. This means the entity actually holds or controls the legal rights to its assets shown on the balance sheet, and that the liabilities listed are truly its legitimate obligations. Does the company actually own that building, or are those debts really theirs?
Ownership and responsibility. Got it.
And finally, UP stands for Understandability of Presentation and Classification. This asserts that transactions are put into the proper accounts, they're grouped or separated appropriately on the statements, and all the financial information is presented clearly and is, well, understandable to the users reading the reports. Are expenses categorized logically? Is it easy to follow?
Cover up. Okay, that's helpful. How do auditors use these?
Well, we identify the relevant assertions for each significant account balance or class of transactions. Relevant assertions are those that have an identified risk of material misstatement, thinking about both the likelihood it could happen and how big the impact might be. And we do this before even considering the company's internal controls.
Can you give an example?
Sure. For, say, revenue transactions, completeness and occurrence are usually highly relevant. We want to know if all sales were recorded and if the recorded sales actually happened. For inventory, existence, completeness, and valuation are almost always key relevant assertions. Does the inventory exist? Is all of it counted? Is it valued correctly?
Okay.
So auditors use these relevant assertions to pinpoint exactly where misstatements could potentially occur. And then we design specific audit procedures to directly address those specific risks tied to those assertions.
So the assertion drives the test.
Exactly. For instance, to test the existence assertion for inventory, what might we do? We might go physically observe the inventory count in the warehouse. To test the completeness assertion for inventory, we might trace receiving reports back to the inventory records to make sure everything received was recorded.
Got it. And one procedure might cover multiple assertions.
Yes, that happens.
Sure.
Physically observing the inventory count gives evidence about existence, but also some evidence about completeness and valuation, observing its condition. Conversely, you might need multiple procedures to get enough evidence about a single assertion, like valuation.
Okay, that clarifies assertions quite a bit. So all this incredibly detailed thinking goes into writing the audit plan. What does that final document actually look like?
Right. So after gathering all that planning information, understanding the risks, identifying relevant assertions, the detailed audit plan is drafted. And like we said, a written audit plan is always required for every audit. It's essentially a highly detailed list of all the specific audit procedures we believe are necessary to achieve our audit objectives.
It's the instruction manual for the audit team.
Exactly. It serves as a comprehensive work plan, or program, for the supervising auditor and all the assistants on the engagement team.
How specific does it need to be?
It needs to be quite specific. It has to outline the nature, the extent, meaning how much testing, and the timing of the work to be performed. And importantly, it always references the specific assertion or assertions that procedure is designed to address.
Can you give a format example?
Sure. A typical procedure in the plan might read something like, perform confirmation procedures on a specified number, say 100 accounts receivable balances, selected from the aged trial balance as of a specific date, maybe year-end or an interim date.
Very clear. What to do, how many, and when.
Precisely. This clear format ensures everyone on the team knows exactly what needs to be done, how much of it, and when it should happen. And of course, as the audit progresses, if we find new information or circumstances change, that initial audit plan isn't set in stone. It's a living document. It can be, and often needs to be, modified.
And what about big companies with lots of parts?
Good question. For complex, multi-entity engagements group audits, a specific group audit plan is also developed. That details how the work will be coordinated with auditors looking at different components or subsidiaries.
Okay. And finally, on planning. Who gets to see this master plan? And why is communication so important at this stage, even before the main audit work kicks off?
Communication is key here. It's a standard requirement for the auditor to communicate the planned scope and timing of the audit, including any significant risks we've identified with those charged with governance.
Meaning the board or the audit committee?
Exactly, the audit committee or the board of directors if there isn't one. The main purpose of this communication is, well, twofold. It gives them insight into what we're planning to do, and importantly, it helps enhance our own understanding of the entity by getting their perspective. It also helps them fulfill their oversight role for the financial reporting process.
What kind of things do you discuss?
We might talk about how we plan to address the significant risks we identified. Our general approach to looking at their internal controls, factors that affected how we determine materiality. whether we plan to use the work of their internal audit function or maybe external specialists.
Okay.
We also discuss our approach to any significant changes in the financial reporting framework they use or major shifts in their business environment. But, and this is a critical caution, we're careful not to make our audit procedures so predictable that management could potentially anticipate them and, circumvent them.
Ah, maintaining unpredictability. Makes sense.
Definitely. We also use this communication to actively solicit information from governance. We might ask who they typically communicate with, how responsibilities are divided between management and the board, discuss the entity's objectives and risks from their perspective, ask about any areas they want us to pay particular attention to, or discuss their communications with regulators.
So it's a two-way street.
Very much so. We also discuss their attitudes and actions regarding internal control, fraud awareness, and how they respond to changes. And just to note, for public companies issuers, under PCAOB rules, there are additional required communications, like detailing any specialized skills needed on the audit team, the planned use of internal auditors, or involvement of other accounting firms.
Okay, that paints a really clear picture of the sheer depth of audit planning. It's the essential roadmap. But audits, as you said, are rarely a one-person show, especially with today's super complex businesses. So how do auditors bring in other experts to get the full picture?
That's exactly right. It's often necessary, almost unavoidable, to use the work of others. Modern businesses are just so diverse and specialized. Think about areas like complex financial instruments, pension calculations, environmental liabilities. No single auditor or even audit firm can realistically possess deep expertise in every single specialized field they might encounter.
So collaboration is key.
It's all about collaboration and making sure we have the right expertise focused on the right parts of the financial statements to get sufficient appropriate audit evidence.
Okay, let's start with the people inside the company, the client's own internal audit team. How does the external auditor collaborate with them? Seems like there could be some overlap, maybe even tension.
That's a great place to start. Internal auditors play a really vital role within a company. They strive to maintain objectivity and integrity in their work, looking at controls, efficiency, compliance.
But they work for the company.
That's the crucial distinction. They are not independent of the client in the same way an external auditor is required to be, because the client is their employer. And because of that lack of independence, the external auditor absolutely cannot share responsibility for any audit decisions, judgments, or, ultimately, the final audit report with the internal auditors.
So the external auditor keeps sole responsibility.
Always. Sole responsibility for the audit opinion rests with the external audit firm.
Okay, but can they still help?
Oh, definitely. The work performed by competent and objective internal auditors can significantly assist the external auditor. They can help us gain an understanding of the client's internal control system, they can help in assessing risk, and in some cases, they can even perform certain substantive or control testing procedures that we might otherwise do ourselves.
When is their work most useful?
Generally, their work might be more helpful for less material financial statement amounts, or in areas with lower risk or less subjectivity involved in the evidence. However, and this is important for highly material amounts, or areas involving significant risk or high degrees of subjectivity.
Like what?
Like, say, the valuation of complex financial estimates, or looking at related party transactions. In those areas, the external auditor must still perform direct testing themselves. We can't solely rely on the internal auditor's work for those critical judgments.
And if they provide direct assistance, like working under your direction?
Yes, if internal auditors provide direct assistance, meaning they perform specific procedures directly under the external auditor's supervision, then the external auditor has clear responsibilities. We must thoroughly supervise, review, evaluate, and test the work performed by them, just like we would with our own staff.
And you have to check them out first.
Absolutely. Before relying on their work at all or using them for direct assistance, the external auditor must obtain an understanding of the internal audit function, its scope, its procedures, its access to records. And critically, we have to evaluate their competence, their education, experience, certifications, their objectivity, thinking about their reporting structure within the company, and whether they apply a systematic and disciplined approach, including things like quality control over their own work.
So useful, but with clear boundaries and responsibilities.
Exactly. Helpful collaborators, but the external auditor remains solely responsible.
Okay, moving outside the company then. what about those external experts, like actuaries calculating pension liabilities or appraisers valuing real estate? When do auditors call them in, and what's that process look like?
Right, these are what auditing standards refer to as specialists. A specialist is an individual or a firm possessing skills or knowledge in a particular field other than accounting or auditing.
So, not accountants.
Correct. Think actuaries, engineers, geologists, appraisers, environmental consultants, sometimes even attorneys for interpreting specific complex contracts or regulations. It's important, though, to distinguish between an auditor specialist, someone we engage to help us get audit evidence, and a management specialist, someone the company uses to help them prepare their financial statements in the first place.
Okay, two types. When would an auditor need their own specialist?
We might need an auditor specialist for various things: valuing complex securities that aren't easily traded, or maybe unique assets like fine art; determining physical characteristics like the quantity of mineral reserves for a mining company; developing highly specialized estimates like insurance loss reserves; or interpreting technical standards or legal documents.
So, when the auditor needs expertise they don't have in-house.
Precisely. Now, as the auditor, we don't need to be an expert in, say, actuarial science, but we do need to understand the specialist's field well enough to determine the appropriate scope of their work for our audit purposes, and crucially, to evaluate whether their findings are relevant, reasonable, and reliable as audit evidence.
And you have to vet them too.
Absolutely. We must be satisfied with the specialist's professional competence, their qualifications, certifications, experience, their capabilities, do they have the time and resources, and their objectivity. We need to understand any relationship they might have with a client that could potentially impair their judgment. We look at their reputation, their experience in the specific type of work needed.
Is there usually an agreement?
Yes, it's highly recommended, often essential, to have a written agreement with the auditor specialist. This outlines the nature, scope, and objectives of their work, the respective roles and responsibilities of the auditor and the specialist, how communication will work, and confidentiality requirements.
And how do you evaluate their work once it's done?
We have procedures for that. We'd make inquiries of the specialist. We might review their working papers, looking at the data they used, the assumptions they made, the methods they employed, and we review their final report or findings. We might even perform our own corroborating procedures, like comparing their assumptions to market data. Or if there are significant concerns, we might even discuss their findings with another specialist.
Okay, now the big question. Does using a specialist affect the auditor's report? Do you mention them?
That's a really important point. Generally speaking, if we issue an unmodified, clean audit opinion, we do not make reference to the work of the auditor specialist in our report,
No.
because ultimately the auditor retains full responsibility for the audit opinion. Referring to the specialist might imply a division of responsibility, which isn't permitted for an unmodified opinion. We typically only make reference to the specialist if their work leads us to issue a modified opinion, maybe because their findings indicate a departure from GAAP, or if we had a scope limitation related to their work. Or sometimes, reference might be made if their work is discussed in sections like critical or key audit matters.
So no reference usually means the auditor is comfortable taking full responsibility based on the specialist's work.
Exactly. Now, what about when it's management specialist, the one the company hired?
Right. How do you handle that?
Our procedures are a bit different then. We still need to evaluate that specialist's competence, capabilities, and objectivity. We need to obtain an understanding of the work they performed. And then we need to evaluate the appropriateness of their work as actual audit evidence for the financial statements.
What influences that evaluation?
It depends on things like the significance and complexity of the matter the specialist worked on, the overall risk of material misstatement in that area, and the nature of the relationship between the client and their specialist. The more significant or risky the area, the more persuasive the audit evidence we need to obtain, which might involve more rigorous evaluation of the specialist's assumptions, methods, and source data.
Okay, that makes sense. Now, in our super digital world, data and IT systems are absolutely everything. So who handles the tech side of the audit? It can't always be the traditional accountant, right?
You're hitting on another crucial area. This brings us to the IT auditor. Now, an IT auditor is generally considered a specialized role, but they're distinct from the specialists we just discussed. An IT auditor is typically considered a member of the engagement team itself.
Ah, so part of the core team, not an external hire necessarily.
Often, yes, though they might be from a specialized group within the audit firm or even contracted. But they function as part of the team because information technology has such a profound impact on how financial information is generated, processed, stored, and reported. Specialized IT auditing knowledge is pretty much essential on most audits today.
What do they actually do?
IT auditors get involved throughout the audit process, right from the start in understanding the client's IT environment and how it relates to internal controls. They help assess IT-related risks. They design and perform tests of IT controls, like checking user access rights or system change management. And they can also perform substantive procedures using IT tools, like data analytics.
And who supervises them?
The same general principles of direction and supervision apply. The engagement partner is responsible for ensuring there's clear agreement on the scope and objectives of the IT auditor's work, that communication flows effectively, and for evaluating the adequacy of their findings and ensuring they're integrated into the overall audit. But again, the audit partner remains fully responsible for the final report on the financial statements as a whole.
Got it. One more category. What about those really large, sprawling companies, maybe multinationals with branches or subsidiaries all over the place? How does one auditor handle auditing the whole group when pieces are audited by different firms?
That's where the concept of a component auditor comes in. In what we call a group audit, a component auditor is another auditor, often another firm entirely, who performs audit work on the financial information of a specific component of the group.
A component like a subsidiary or a division.
Exactly. It could be a subsidiary in another country, a major division, maybe an equity method investee. This component auditor's work is then used as audit evidence for the overall group audit.
Why involve a component auditor?
Several reasons. It might simply be necessary to obtain sufficient appropriate audit evidence, especially if the component is geographically distant or significant. Sometimes there are legal or regulatory requirements for that specific component to have its own separate audit. Or maybe the component auditor was already engaged for that component's standalone financials.
Okay, so who's in charge overall?
The group auditor, that's the firm auditing the main consolidated financial statements, retains ultimate responsibility for directing, supervising, performing, and reporting on the group audit engagement. We have significant responsibilities regarding the component auditors.
Like what?
We have to obtain an understanding of the component auditor. Are they independent? Do they comply with relevant ethical requirements? Are they professionally competent? We also need to understand the regulatory environment they operate in, especially if it's different from ours.
Do you coordinate the work?
Absolutely. The group auditor typically provides written instructions to the component auditor. We agree on a nature, scope, timing, and objectives of their work on the component's information, clarifying our respective roles and setting up communication protocols.
And you review their work.
We review communications from the component auditor. These would cover things like their compliance with our instructions and ethical requirements, any significant risks they identified, any uncorrected misstatements they found, indications of possible management bias, identified internal control deficiencies, and any other significant matters relevant to the group audit. Depending on the risk associated with the component, we might also need to review parts of their audit documentation.
And how does this affect the final audit report for the group? Do you mention the component auditor?
This is another area where the report is affected. If the group engagement partner decides to make reference to the audit of a component auditor in the group audit report, which is a choice, not always required, they must do it very clearly. The report must explicitly state that the component was audited by the component auditor. It needs to indicate the magnitude of the portion of the financial statements audited by them, usually stating percentages of assets, revenues, etc. And it must clearly state that the group auditor's opinion on the consolidated financials, as it relates to the amounts audited by the component auditor, is based solely on their report. It clarifies the division of responsibility for that specific part.
Wow. Okay. We have really journeyed through a complex landscape today, from the meticulous blueprint of audit planning to the essential collaboration with internal auditors, specialists, IT auditors, and component auditors. It's quite the undertaking. You've definitely given us a significant shortcut to being incredibly well-informed about this vital field.
It really is a deep process, isn't it? And I think understanding these layers, the planning, the risk assessment, the use of various experts, it truly builds trust and hopefully an appreciation for all the unseen work that underpins the reliability of the financial information shaping our economic world.
Absolutely. It highlights just how many checks and balances, how many layers of assurance are built into the system to give us confidence in those numbers we see.
Couldn't agree more.
So here's a final thought for you, our listener. The next time you glance at a company's annual report or see their financial results announced, how might your new understanding of the intricate planning and the expert collaboration that went into producing those numbers change your perspective on their reliability? Something to ponder. Thanks for joining us on the deep dive.